Year-end brings a reset to the tax year shot clock. Today, we're breaking down the 6 things you need to do before year-end to optimize your investing strategy. It's fun to think about building the perfect investment portfolio, but what really moves the needle is how and where you're funding your accounts and taking withdrawals from. When done correctly, you're not just investing better, you're putting more money to work and keeping it out of the tax man's hands. You've got 2 weeks, now go get to work. From Wall Street to managing hundreds of millions in client money, Nick and I use our alphabet soup of credentials to discuss the investing and tax strategies that actually work. Oh, and we played Division I college football together, so strap in. This one hits hard. Let's go. All right, guys, at LifeGo on all of our socials, the bulk of our time is talking about setting up an investment portfolio that can capitalize on the current market environment. Today, we're going to talk about something that goes up the food chain and is arguably way more important to your overall success. It's the stuff involved in financial planning. So coming into year end, what we're going to discuss today is 6 topics around how to get yourself strategically aligned to best capitalize financially in 2026.
Yeah, so I think one of the first topics that's on that checklist to kind of go through at the end of the year when you're looking at financial planning, the first one would be maxing out your retirement accounts. There's a lot of debate about this on how the best go about it, but just a few headline stats there. Fewer than 15% of Americans max out their 401k in any given year. Now, that's a relatively low number. A 35-year-old making around, just 7% returns if they're making the maximum contribution. By the time they're retired, that's going to be an account roughly in the range of $3.5 to $4.5 million. And that employer match, which can make a really big impact when you're thinking about growing money that's going to compound over time. I think it's something that in any given year is something worth going back, looking at what we contributed this year, and was that the right number, and can we push that higher?
Yeah, I think the employer match is just out and out free money. And I'll actually just rewind back to the beginning of my career, because I remember as a 22-year-old or whatever, even working in the financial industry on Wall Street, I remember taking out and saying, I'm going to put 10% of my income away. Admittedly, I had expenses that were basically zero, and I think I was making $40,000 a year at that point. So 10%, all of a sudden I'm putting away $4,000. And at the time, the max was probably like $16,000 or $17,000. And I almost, because of my such low expense level, had the ability to max that all out. And just my financial wherewithal at the time told me I can't afford to put more than 10% of my money away. And I understand the psychological component of it, because people say like, this is money that's going to be stuck until I'm 59 and a half. But the reality is it's stuck, no doubt, but you're investing with that money an additional 25% of what you would, or whatever your tax bracket is, 33%, 20% tax bracket, whatever that tax bracket is, that's the amount more money you're putting to work in the market that's going to compound from that point until you're at least 59 and a half. So the alternative is take the money out, pay the piper, which is Uncle Sam, and your state Uncle Sam, and your local Uncle Sam, and then take that money and invest it. That just is not an equation that is, at the end of the day, productive relative to put the money away tax-free.
No, and if you're a high income earner at this point too, let's say you've got a combined marginal tax rate of 40%, every $23,000 contributed is about, a little over $9,000 in tax savings today. So that's a lot of money to be leaving on the table.
Totally. And I just used a word that said tax-free, and clearly that wasn't the best used word there. It's tax-deferred, right? Because on the back end, you're going to wind up paying taxes as you take that money out. And I think one of the large arguments on social media is, hey, put money in your 401k up until your employer's match, and then fund the Roth thereafter. And I take huge problem and issue with this, because I think that that's all predicated around a couple thoughts. One is everyone's thoughts are just that taxes are going higher. And Nick, you and I entered this industry in 2010, right? The prevailing wisdom, the entirety of our careers, is that taxes are going higher. We're in $37 trillion of debt. We're going to see ridiculous tax explosion. Well, what direction have taxes gone the entirety of our career?
The other way, my man.
They've gone down, right? And there's just no political wherewithal for folks in Washington, D.C. to come in and say, hey, I want to be the next president. I want to be the next senator. And by the way, what's on my agenda? I'm going to raise your tax. Well, guess what? You're not going to get elected. So I think that you're betting on the fact that in the future, taxes are going to be higher with putting money into a Roth, which means you've already made the tax payment on it, instead of putting it into maxing the 401k, where you're putting all that money away, that additional 20%, right, that would have normally gone to Uncle Sam, that 20% is compounding from now when you're 25 years old till you're 59 and a half. What's that additional 25% at the end of the day? Huge.
Yeah, and I think it does take away, too, from the ability to plan longer term. When you're thinking about the RMDs that you're going to be experienced later from these retirement accounts, there's different levers that you may be able to pull later on down the road that can reduce that rate. So you're guaranteeing, you're locking in that taxes today, but you're again assuming that taxes are going to be higher in the future, and number two, that you're not going to have any other levers to pull to be able to offset that. So it's a bit limiting in that regard.
So I think there's other things to think about too. So if you're an employee, right, in a 401k, you can contribute $23,000, right? And then your employer match can be on top of that here in 2025. But there's also, if you're a business owner, there's lots of other options in the market, right? There's solo 401ks, there's simple IRAs, there's SEP accounts. And then the most powerful one of them all, by the way, those underlying that I just spoke about there, most of them, you can contribute up to $69,000 in 2025 if you have the right income limitations and things like that. Defined benefit plans, there are literally no cap on what you can put in a defined benefit plan. We've got a client right now setting up a defined benefit plan where he's going to fund it pre-tax with over $1 million of income, where the government's not going to touch that income. That income, he is very, very clearly in the highest tax bracket. He would keep $600,000 of that. So him putting in that defined benefit plan, bang, $400,000 additional money gets put to work, right? More than $400,000. Now, granted, he makes an absurd amount of money. Let me be clear. Anyone contributing pre-tax $1 million is making ridiculous money. But at the end of the day, that's the reality of it. So know your options. If you're a business owner, make sure you're talking to somebody that has an idea of what plan perfectly fits the needs that you have, because a lot's dependent upon what style of business you're running, how many employees, are they W-2, are they 1099? That's going to shift you from one plan to another. What you're looking for is the plan that allows you to maximize that pre-tax contribution to your retirement plan.
So another thing on that checklist that we want to make sure that we're taking a look at the end of the year is our levels of cash and the cash drag that's produced in your overall portfolio and the opportunity cost of that. It's important to look at that number at after inflation type of level, because the cash often returns negative real returns. So if you're sitting on $250,000 at cash earning next to zero in real return, the opportunity cost is really, really significant over your lifetime. So I think it's important to realize that the average household holds about 2 to 3 times more cash than they actually need for emergencies. And that makes a lot of sense. It's something that, just in case anything ever happened, you want to make sure you have enough. But there's levers that you can pull in your other portfolio, earning a higher return to protect your principal in the high likelihood that an emergency does not happen. So cash feels safe, but inflation doesn't really care how cautious you are, I think is an important thing to realize.
I think you're so right, my man. I think everyone thinks about that as that warm, fuzzy blanket. We hold cash all the time, and it's just something that we know is always going to be there at the end of the day. But the reality is it's not just the fact that inflation's eating away at it. It's that tax is eating away at it as well. So most people quote, high-yield savings accounts right now. By the way, they're going to wither, and they're going to continue to wither as the Federal Reserve continues to cut interest rates. So last week, they cut by 0.25%. Your high-yield savings account immediately notched down the yield that it's paying by 0.25%. High-yield savings accounts, treasury bills, money markets, etc. So if you now take it down and those are yielding about 3.5%, well, inflation is 3% as of right now. CPI, inflation headline level is 3%, right? But you don't realize, and what they don't advertise at the bank is the fact that, yes, you're getting that 3.5% yield, but guess what? That hits your ordinary income tax, right? And so all of a sudden now, if you're in a 40% tax bracket, add your state on top of that, all of a sudden you're getting cut in half. You're yielding 175. after tax. 175 after tax, I'll reiterate, CPI is 3%. That is a negative 1.25% real return. So you're just having purchasing power and tax consideration whittle away at your underlying cash position. But I think that the other thing that's really, really important to start to understand here is that there are other options, and you have to understand what that cash is really meant for. So one of the things that we do with clients is we start to think about, okay, last year, what is it that you utilized from a cash perspective? What were your annualized expenses versus your annualized income? And so what was left over at the end of the day? Was it too much? Like if you have significant additional savings versus the expenses, that's cash that is now getting eaten away from a purchasing power perspective. It has a better use in your portfolio. And what is it that you have that cash for? Is it something that's shorter term in nature, 1 to 3 years? That's an investment strategy. Is it something that is longer term into the future? All of those things are what you need to consider to design that portfolio in order to meet those needs. But cash drag is a silent killer to overall wealth creation. What we say to folks is cash is for purchases. And so if you have a purchase lined up, then understood that you're carrying on a significant amount of cash. If you have a significant amount of cash above and beyond your needs, that is opportunity cost lost.
Yeah, and again, it's all about portfolio construction and having that sleeve in there where it's not going to be sitting in cash. It's going to be getting you something, but you're still going to have access to that capital in a relatively short period of time if you need it. Those are liquid securities that we can sell and get back to you in a very short period of time. But in the event that something doesn't happen, you're getting that higher level of return and, again, protected against inflation just chewing away at it.
We did an entire podcast. It was myself and the CIO of our company at LifeGoal that we were just discussing, hey, what is it you do with cash when you have too much? And we went into depth about different strategies that can be deployed in order to get that cash to work. Some of it's literally talking about, hey, I want this to be a cash plus type vehicle. And what cash plus right now means is, and we talk about this in the podcast, it was just a couple weeks ago now, where it says, listen, you've got 2 to 3% downside risk. In a nasty environment, maybe it's 5% downside risk. And what you're getting kind of forward looking projected is 2x the return of that of a money market or something like that. So if you have the ability to take on some wiggle out of the underlying performance, then there's significantly better returns on offer in the market. And you need to start to think about deploying those strategies so you're not sitting on cash and have it drag down your portfolio.
Totally. And I think that kind of leads into the third leg of our checklist, year-end checklist here, which is tax loss harvesting. Studies have shown that systematic tax loss harvesting can add almost 1% per year in after-tax returns. And over a 20-year period, that can add up, to almost 10, 20% more wealth with the same type of market exposure. I think it's really important to understand the rules around that. The IRS allows for unlimited carry forward of capital losses, and then making sure that we're using those to offset gains, reposition portfolios, and again, make sure that we're in the best possible position going forward. So I think a lot of retail investors, I think depending on the studies that you're looking at, over 70% of self-directed investors fail to harvest losses efficiently, and that's something we're laser focused on for our clients here.
I always say to folks, like, the silver lining to a bad investment that's going down in value is the ability to capture that loss, right? It's never fun to say, you know what, swallow my pride, I got to take a loss on this and move into something else. But the reality is in the market these days that with the advent of ETFs, there had just been a mass proliferation of ETFs. And so I think the number is something like 4,000 ETFs available in the market today. Now, if you have an ETF, right, which is where we typically talk to people about the best exposure to public markets, whether it's public stocks, public bonds, and you have an ETF that goes to a loss, what you do is you sell that ETF and you buy one of the 9 twin brothers and sisters that look identical to the strategy if you want to maintain the exposure. So you can sell something hypothetically from iShares and buy something from Vanguard that is going to be nearly identical. You're never going to see a difference in performance at the end of the day, but it's allowable by the law. The IRS looks at it as 2 different QSIPs. You sold the Vanguard product or the iShares product, captured that loss. If you want to maintain the same exposure, you move it directly into the other ETF, bang, you've captured that loss, and you're off to the races to offset a gain in the future that you may experience with the loss that you have just banked. Think about it as a piggy bank. You're just throwing pennies in it. Every time you're able to capture a loss, boom, throw another penny in, because at the end of the day, you're going to have gains at some point in the future, and you're going to want and be happy that you've harvested those losses in the rearview mirror because you're saving on those tax dollars. But yeah, Nick, it's incredibly important. It's not as easy on the individual stock side, right? So say you own hypothetically a Tesla or something like that, and that goes to a loss. You're not able to sell something or sell Tesla and buy the identical. Like you can't buy Lucid or Rivian or whatever it is, and they're going to have the identical exposure. But at the end of the day, the wash sale says 31 days. So if you sold Tesla, you want to buy it back, wait 31 days if you have a meaningful loss there in order to capitalize on that to offset a gain in the future. But you are running the risk there in an individual stock, which we really aren't proponents of individual stock buying to begin with. In that 31 days, if you got a bounce, you wouldn't experience that bounce. So there's the downside on the other end. Yeah,
but I just think it's, you're going to have this is going to be with this checklist. Not every year you're going to be able to pull the trigger on some of these things. This is one of those years, 2025, across the board, whether you're stocks, bonds, private markets, whatever you're in, you're sitting pretty on most of those different asset classes. So you're not always going to be able to take advantage of it, but we want to make sure that we have a plan in place that when they are there and available, that we're maximizing the use of those.
Yeah, and the last thing I'll say on tax loss harvesting is just like bird in the hand is worth two in the bush, right? And what I mean by that is, hypothetically, if you're in that Tesla position that's at a loss, you know definitively if you sell that, there's an advantage to doing so. You are getting a benefit by selling that, by saving on taxes in the future to offset a gain somewhere else. Whereas if you don't sell it, what your hope is, the unknown, that it's going to bounce back over that 31-day period of time, because that's your opportunity cost, the ability to sell it now, wait 31 days, rebuy if you want to maintain that exposure going forward. But the other game is people are like, I don't want to do it because I'm afraid of the pop that could potentially come. That's an unknown. The known is the tax advantage you're getting by selling.
So moving down the checklist here, I think charitable giving strategies is something that is kind of a unique opportunity that helps clients kind of manage their tax situation and estate planning kind of across the board. Some kind of headline stats around that. Donating appreciated securities, which is typically the best way to go about it, can increase the effective gift value that you're giving to that charity by 20 to 30%. And these qualified charitable donations can be very impactful from a tax perspective. QCDs can actually reduce your adjusted gross income, which will affect your Medicare premiums, Social Security taxation, and so on. So I think it's a really unique tool that if you are charitably minded and are looking for some levers to pull to help on the tax front, to do that, this is a strategy that can really be impactful for a lot of folks.
Yeah, and Nick gave a 20 to 30% statistic there. It's not very hard to back into where that 20 to 30% statistic comes from. So say, we're going back to Tesla now. So some people have ridiculous gains on Tesla. They bought it 20 years ago, 10 years ago, whatever the number is. So if you have this Tesla position that you bought for $100,000 and now it's worth $2 million, you've got two options. If you are inclined to give away to charity, you can sell it and pay the capital gains tax, which if you're in a lower tax bracket is at 15%. If you're in a higher tax bracket, you're at a 20%. And I think the annual income limitation there is something like $450,000. So if you're over 450, you're paying 20%. But by the way, then you're putting Obamacare on top of that, which is an additional 3.8%. So now you're at 23.8, and now you happen to live in a state that has a capital gains state tax rate as well. The higher tax states, literally, you're giving away a third of the gains that you've made on that Tesla position. So you're selling it down to get cash, and then you're giving charitable contributions out of that after giving 33% of your gain away. Don't do that. Don't do that. Don't do that. Your charity deserves better than that. Give them the underlying stock. Allow them in a qualified manner, allow them to take that stock, sell it themselves, and get 33% more value out of that at the end of the day. That's really the power of what the tax law allows you to do if you just know what the underlying rules and structure of the tax law is. And charity is something that allows people to give phenomenally, that allows them to have that maximum tax benefit.
Yeah, and it can help with RMGs too for folks who have large IRAs that are going to have massive RMD requirements. There's strategies, gifting strategies that you can use to make that RMD payment, essentially take it straight from the IRA, give it to the charity, and it lowers your AGI, right? Which can have an impact on your Social Security, how that's taxed. There's a lot of different impacts downstream from that. So I think charitable giving in a variety of situations can be a very impactful tool, again, to helping navigate the tax situation as well.
I think that you look at it and you finally say to yourself, hey, do I want my charitable giving to be taken out by the government and allow them to use my money? Or do I want to give the money directly to the charity and allow the charity to utilize it, which I believe in the cause of doing? Clearly, I want to maximize that to the charity, not allow the government to get their grab and then the remainder going to the charity. If you want charity, give to charity. Don't give to the government. Right?
So next on the checklist here, we want to talk about RMDs and planning on that. If you're heading into retirement and thinking about planning your cash flows in the future, this is a really important area where planning can have a huge impact. So just some headline statistics on RMDs. You don't want to miss one. That's for sure. Missing an RMD automatically triggers a 50% penalty. It is one of the cruelest and harshest in the entire IRS tax code. And I think most, looking at a lot of studies, nearly 40% of retirees underestimate their future RMD tax impact. If you're a retiree, let's say with a married couple with $2 million in an IRA, you're going to have $75,000 in annual taxable income from just the RMDs alone. So I think it's really important when you're looking at these RMDs, get ahead of it and make sure you have a plan in place to help navigate those cash flows and plan those out. And the other big one that we see a lot is from inherited IRAs. There's a 10-year rule where an inherited IRA must be distributed to the beneficiary within 10 years. So let's say you inherit $1 million IRA, that could push you into a higher tax bracket for the next decade. So I think planning around these, having a really strong idea of what you can expect in the future, and developing the strategy is crucial here.
I think when it comes to understanding RMDs, when it comes to understanding anything about the government and taxation, understand this. They're either getting their tax in one way or the other. So an RMD is coming from a qualified retirement account, which means it's been money that you've put away that the government has not put their finger on from a taxation perspective. And so the massive benefit of a 401k is if I'm investing now and I'm 35 years old, I'm putting 100% of the money away that's going into that 401k before the government takes a dollar out of it. Conversely, you're able to take your paycheck, give $30 of every 100 away, and then take your paycheck at the end of the day. So this is the advantage where you have that additional $30 being put to work and being invested. And the power of that $30 compounding additionally that wouldn't have done so if you didn't contribute to a 401k is just mind-numbing at the end of the day. Time value of money is the eighth wonder of the world. That's what Albert Einstein says, right? But the reality is that comes with a hook. On the back end, if you haven't paid taxes yet, you need to pay taxes. And the way they forced taxation to come out of those dollars is through required minimum distributions. It's kind of funny that all of a sudden we all go from, hey, we love income, we want to make income, we want money in our pocket, to saying, I actually don't want this, right? Keep that money or stuffed away where I'm not paying tax on it. The government just doesn't allow you to do that. So Nick, I think it's important to start to think about planning around that. And I think one of the things that often comes up, and we've already mentioned this before, is talking about a Roth conversion strategy. So I don't know, you give your thoughts there, I'll give my thoughts there, because I think that we might have differing opinions on this. We'll see.
It's one of the most talked about financial pieces of advice out there on the internet today. A lot of folks think it's kind of a no-brainer that you should absolutely do that. But again, there's a lot of assumptions built into that. And it doesn't work the same way for everybody. Your individual circumstances have a great deal of impact on whether that's the right decision for you or not. So, that's kind of my take on it. It's not as much of a no-brainer as it's marketed out on the internet.
I totally agree. I think that when it comes to a Roth conversion, understand that what you're trying to do is thread a needle. And I mean that. What you're trying to do is find low-income years So maybe just after retirement. So when it can make sense, when you're trying to thread the needle and when it can make sense is after you've retired, before your RMDs kick in, oftentimes there's a period where there's a lull where your income is a little lower, right? And that's a period when potentially you're able to thread that needle. But again, when it comes to paying tax now to avoid paying tax in the future, I think a lot of the thought on the social media gurus that are often know-nothings say is, hey, taxes are going to go in the higher in the future, and therefore pay them now, don't pay them in the future. But at the end of the day, when you're paying them now, that means you're taking 30% of that dollar that you have invested out to pay now and not allowing that 30% to compound for the next 10-year period of time before those RMDs kick in. I want that additional $30 out of every 100 compounding over that period at a 7, 8%, 9%, 10%, whatever the return rate is, because the compound nature of math just causes it to be so much more powerful. And then I'll pay the tax on the back end. By the way, on the back end, oftentimes your taxes are going to be lower. Now, if you get pushed into RMDs, then you're going to have more taxable income and it's going to raise you up that tax bracket potentially. But even $75,000 of income, that's not a ton when it comes into the grand scheme of things, which is the quote that Nick gave on a $2 million retirement plan, $75,000 of added income from that required minimum distribution. So that's not the biggest number in the world, and it doesn't thrust you up that high on the marginal tax rate to push you into an arduous area of tax. And I don't think that we can count on taxes going higher in the future because we haven't seen it for 15 years.
Yeah, it is quite the political strategy to run on in your campaign, and just talking about raising taxes across the board. Hasn't worked out historically, and the folks who do run on that typically don't actually implement it. So I think it's a wait and see, improve it type of situation there for me.
Yeah, George Bush Sr. Why did he not get reelected? Because he said no new taxes, and then he raised taxes, right? So it's something that if you do it, you don't get reelected. That's the proof statement there.
Yep. That's for sure. I think then the last thing we want to go over in this kind of year-end checklist here is gifting and family wealth strategies. There's looking at how we're going to be moving assets from one generation to the next in the most tax efficient way possible. I think this is a really important thing for some folks to start looking at. There's an annual exclusion. You get $18,000 per person, $36,000 per married couple per recipient. A couple with 3 kids or grandchildren can give a gift of, let's add it all up, $252,000 per year tax-free. So over 20 years, that's a lot of money you can move out of your estate, transfer to the next generation in a very tax-efficient way. So that's something we really like to encourage folks to take a peek at this time of year.
I think that's mind-numbing to most people to think that you've got 7 people you're giving money to between your kids and your grandkids, and all of a sudden you're giving away $250,000 per year. So think about it from a psychological perspective. I think that next generation probably needs the money now more so than they do in 20 or 30 years when you pass and all of a sudden they're 60 years old. They don't even need the money at that point. They've established themselves. But if you can give them $36,000 a year, give their kids $36,000 a year, right? Give their wife or husband $36,000 a year, that is hugely, hugely beneficial because at the end of the day, that is a way to get money from one generation to the next now, right? And especially it's impactful for folks that are going to be above that estate tax threshold at death. So if you have real wealth, this is a way to start chunking away, again, in this 7-person example of 4 grandkids and 3 kids, $250,000 on an annualized basis. Another really powerful way to do it is on the 529 front. So 529s are college savings plans. We all know that college savings is, college price rather is going up at an astronomical rate, much faster than broader inflation. Well, 529 plans allow what's called a 5-year forward contribution. So a 5-year forward contribution means that a married couple, right, can give away 5 years worth of annual gifting into that overall, on an annual basis there. So that's $180K per kid. And I misspoke there. So you could put 5-year forward. So you could put away $180K per kid one time every 5 years. So if you've got 10 grandkids, right, this is a way in 1 year to put $1.8 million and move it to the next generation without taxes touching it. And the great thing about a 529 plan is the fact that you put money in, it grows tax-free. They take it out so long as it's used for secondary education, tax-free, et cetera. So it's an awesome, awesome way to get money put away without taxes coming in and crushing you and allow it to skip to the next generation untaxed. All right, y'all. Those are the 6 crucial things you need to do before year end. If you need help executing on any of this, obviously we're here and happy to help. Enjoy the holiday season, and we'll chat again next week.
The information discussed in this video is for educational purposes only and should not be considered investment, tax, or financial advice. Investing involves risk, including possible loss of principal. Always consult a qualified financial professional before making any investment decisions. Past performance is not indicative of future results.